On December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law. From before the Revolutionary War, for over 130 years, our country frequently experienced periods of worthless money and financial panic. The Congress and the President hoped the creation of the Federal Reserve System would prevent these things from happening again. The establishment of the Federal Reserve marked a turning point in the banking and monetary system in the United States. To understand why the Federal Reserve was created, we need to understand what money is, and, historically, what have been the consequences of too much or too little money in the American economy. To begin with, money is a medium of exchange. That means that people generally accept it in exchange for the things they sell or the work that they do. Today, 75% of our money supply consists of deposits at banks. The rest is in the form of paper bills and coins. Without money, you would have to barter, trade your goods and services directly with other people for their goods and services. We couldn't have a modern economy relying on barter. It seems simple enough. Money is needed to buy and sell things, except sometimes it's not so simple.
Hey, Priscilla! Priscilla! Come on, Priscilla, let's make a deal. You said you wanted to sell the car.
Well, I don't know, man. I mean, you know, this car's been in my family for a long time. It's kind of like an heirloom, you know. What's your offer?
I don't know. What are you asking?
Well, I was going to ask $1,200. But it needs a little work, and you're a good friend. For you, $1,000.
Oh, I was afraid you were going to say that. Look, I only have $200 in my savings account, and that's going to have to go for insurance and license plates and all that stuff.
Hey, maybe your folks. I mean, maybe you can borrow from them.
No way. You know, Dad did co-sign a bank loan for my sister once.
Yeah?
Maybe. Just maybe.
My guess is that Matt has a plan for getting the money. We'll check in later and see. One thing is for sure. Matt is going to get his money in a different way than he would have, say, 250 years ago. When the country was first settled, beads, shells, furs, tobacco, and metals such as gold and silver were used as money. The amount of money was a problem in colonial America. England wouldn't furnish enough coin or let her colonies mint their own. By limiting the money supply, the English government wanted to force the colonies to trade exclusively with England. Many colonists didn't like that.
The scarcity of gold and silver coin forces us to barter and use things like tobacco and furs as money. Some colonies are printing paper money, which has been forbidden by the British. We do not like it. They keep denying us the right to find solutions to our own problems.
Yeah, they are our own problems.
Well, of course, the British never did allow the colonies to find solutions to their own problems. In fact, stricter trade regulations and new taxes were imposed. Friction mounted.
Well, it's come. Our Continental Congress has met, and declared our independence. We are now the United States of America, and dead broke. How are we to pay for this war?
A good question. The Continental Congress had no power to tax. So to finance the Revolutionary War, it not only borrowed from Europe, but began to issue paper money called continentals. As the war continued on and expenses mounted, more and more continentals were printed. By 1779, the purchasing power of a continental was, well, the expression of the day was, it isn't worth a continental. The experience with continentals was so bad that the government didn't issue paper money again for 80 years. The young nation had experienced what too much money in the economy can cause: prices to go up and money to lose its value. And when you begin to buy things for yourself, the value of money becomes very important.
How you doing?
Okay.
Now, I'm going to co-sign for the loan, but the payments are your responsibility.
Sorry to keep you waiting, but you know all this paperwork. Now, Matt, if you'll sign here and here, and Mr. Williams here and here.
There you go.
Well, Matt, as of right now, you have $1,000 in your checking account.
Today, when banks make loans, borrowers generally get their money in the form of a checking account in the borrower's name, just as Matt did. But in our early history, when banks made loans, borrowers got banknotes. That's because there were no checking accounts. Besides, few loans were made back then anyway. The founders of the country were much more concerned with overcoming the shortage of coin and avoiding the overissuance of paper money. The adoption of the Constitution in 1789 helped to correct the shortage of coin by giving the Congress the sole power to coin money and regulate the value. So, under the direction of the first Secretary of the Treasury, Alexander Hamilton, the first U.S. mint was established in 1792. The United States finally had its own monetary standard. Among the first coins minted were these: $10 gold coins called eagles and silver dollars. These are collector's items today, but in 1792, they were our first standard currency. Also, in 1791, Congress granted a 20-year charter to the Bank of the United States. This privately owned bank issued a limited number of paper notes, which were redeemable with reserves of gold and silver coins. And people considered these notes to be as good as gold. But there were other notes circulating. They were issued by private, state-chartered banks and were also redeemable by gold and silver coin reserves. Often, these notes were overissued. Each bank promised to exchange its notes on demand for gold or silver. For example, this note from the Mechanics Bank of Memphis promises to pay $10. The problem was that many banks didn't keep enough reserves to redeem the thousands of notes they issued, so people hesitated to accept bank notes. In 1816, a second Bank of the United States was chartered, but President Andrew Jackson was concerned that the bank was too powerful, and he allowed its charter to expire in 1836. An era of free banking followed. The number of private, state-chartered banks mushroomed, as did the amount of notes the banks issued. At one time,
there were some 1,600 banks issuing over 3,000 varieties of notes.
The enormous growth of the number of banks, each issuing its own notes, caused serious problems. The fact that there was no overall control over money issuance led to extreme shifts in the money supply, prices, and general economic activity. Clearly, something had to be done. But for the present, more important events were occurring.
Fort Sumter is bombarded. There follows the marching, counter-marching of 2 million men. The Merrimack and the Monitor, Lee and Grant, Shiloh, Vicksburg, Gettysburg.
In your hands, my dissatisfied fellow countrymen, and not in mine, is the momentous issue of civil war. You have no oath registered in heaven to destroy the government, while I have the most solemn one to preserve, protect, and defend it.
This is a terrible conflict. When will it be over? The federal government cannot even raise enough money through taxation and bond sales to pay for or even win this war.
He was right. So the government again started issuing paper money called greenbacks. They could not be redeemed for gold or silver coin, but were declared legal tender. That meant that greenbacks had to be used for payment of debts. But the government overissued greenbacks, and at one point, the purchasing power of a greenback dollar was 35 cents. There was concern that the war might be lost. The Congress felt the need to set up a system of privately owned banks that were nationally chartered, which would assist the government in financing the Civil War.
Now that the war is over, we can finally marshal the financial resources of this great nation. We've established the national bank system. Laws permit those of us with enough funds to get a national charter to open a bank. We'll be permitted to issue national bank notes, which will be safe and sound because they are backed by U.S. government bonds.
National bank notes were safe, although they were not redeemable in gold and silver. They soon became the country's chief currency. Banks also began to hold more and more deposits that were used as money. At the end of the Civil War, more than half of the nation's money supply was in the form of these deposits. This change was very important to the development of money and the growth of the country.
The Civil War has been over for nearly 30 years now. 6 railroad lines cross the country from the Atlantic to the Pacific. We are an energetic, growing nation that carries on trade from coast to coast. And our currency has been backed by gold and silver coins since 1879.
But the backing of currency was to become an issue.
We've been enjoying a rapidly growing economy, but now with this slow money growth, well, prices are falling, people are out of work, and business is in a slump. Farmers know that falling prices are hurting them too. There's just not enough money available. Business can't grow, people can't spend, and prices continue to go down. Something must be done. What's the problem here?
The problem was that money wasn't growing fast enough because there wasn't enough gold and silver on hand to back it.
There were some people who felt that they had a solution to the problem. Mine the more abundant silver for backing. The idea was that the U.S. Treasury would purchase and mint as silver dollars unlimited amounts of silver and use the silver along with the gold as the national currency. Not much gold here. The idea was called free silver, and the argument over free silver became an important political issue.
If you are going to start unlimited minting of all this silver into coin, you will drive down its value. People will start hoarding gold. With too much money in the economy because of all the silver coin, prices are going to rise. Then where are we?
The Populist Party is in favor of this free silver idiocy. They are also demanding low interest rates, abolition of the national banks, and a graduated income tax. As you might imagine, these populists have strong support among the farmers, silver producers, and miners. It's rumored that the Democratic Party will have a free silver plank in its platform for the 1896 presidential election. Heaven help us.
The Democrats did have a free silver plank in their platform and a free silver candidate, William Jennings Bryan. Bryan's Republican opponent was William McKinley, who favored the gold standard. At the Democratic Convention, Bryan made one of the most famous speeches in American political history.
Having behind us the producing masses of this nation and world, supported by the commercial interests and toilers everywhere, we will answer their demand for a gold standard by saying to them, you shall not press down upon the brow of labor this crown of thorns. You shall not crucify mankind on a cross of gold.
In spite of such strong words and dramatic oratory, Bryan was defeated by McKinley. 4 years later, Congress put the United States on the gold standard. This made official what had been fact for some time. It turned out that the gold standard didn't offer the U.S. monetary system much stability. There were repeated money supply difficulties, including the Panic of 1907. During the panic, people streamed to the banks and demanded their deposits. The banks could not meet the demand. They simply did not have enough gold and silver coin available. Many banks went under. People lost millions of dollars. Businesses suffered, unemployment rose, and the stability of our economic system was again threatened.
Well, this couldn't go on. If the country was going to grow and prosper, some means would have to be found to achieve financial and economic stability.
To prevent financial panics like the one in 1907, President Woodrow Wilson signed the Federal Reserve Act into law in 1913. The act created the nation's first central bank with a board of governors to oversee the Federal Reserve and its 12 district banks, each with its own reserve bank and its own president. Policy decisions about money growth are made by these key officials.
The Federal Reserve has political independence. It does not depend on Congress for funding, and its governors are appointed for 14-year terms. The Federal Reserve is independent within government, but not of it. It is required by law to report to Congress regularly.
When the Federal Reserve creates reserves, it enables the banking system to make loans to businesses, consumers, and governments. This, in turn, affects interest rates. When banks make loans, they create checkbook money, as we saw when the bank made the loan to Matt.
Good grief, Matt. What are you, some kind of nut?
Well, I was just in the neighborhood and thought I'd drop by.
Now, what's the deal?
Dad and I, we went to the bank this morning.
Oh, yeah?
Yeah.
And?
Ta-da!
You got the money.
Yep, you want to see my payment book?
No, thanks. I have one of my own.
So are you ready to close the deal?
You bet. I just happen to have the paperwork ready just in case. You do drive a stick shift, don't you?
Yeah. Sure. You got a pen?
You bet.
Thanks.
Anything wrong?
Yeah, I was just wondering if you could finish cleaning the car as part of the deal.
You bet.
And that glove compartment.
Oh, sure. I was gonna throw away most of this stuff anyway.
And, one more thing.
What?
Was wondering if maybe you want to go to the movies with me Saturday night.
Oh, well, I don't know. I might have plans.
Well, we'd have a nice clean car to go in.
Sure. I never get to sit on the passenger side. Okay, very much.
You're welcome. I'll just finish looking her over here.
I'll be through here in a sec.
Well, that certainly worked out well. Matt gets his car, Priscilla gets her money, and both get a movie. Not a bad deal at all. When Matt got his loan and wrote the check to Priscilla, he was doing what millions of people and businesses do every day, borrowing from banks to finance much of their spending for goods and services. The Federal Reserve creates the reserves, the raw material which enables the banking system to lend and invest. If the supply of money grows too fast and causes spending to grow faster than the economy can produce goods and services, then prices will tend to rise and the value of money falls. This is called inflation. However, if money doesn't grow fast enough, spending will slow, and so will the economy's growth. Worse yet, the economy could actually decline, causing unemployment to rise. This condition is called recession. With the right amount of money, spending will grow. Full employment and reasonably stable prices will be easier to achieve. The number one job of the Federal Reserve is to try to achieve a balance between money growing too fast and too slow.
But the Federal Reserve isn't the only factor influencing the economy. The taxing and the spending of the federal government have a great impact on prices, production, and employment. Even events outside the economy, such as weather, and actions taken by foreign governments, often make the job of maintaining economic and financial stability more complicated.
Reduction of 1% in the unemployment rate is a reasonable rule of thumb that assumes
There's always been some disagreement about money and interest rates. Instead of being debated exclusively in the political arena, the Congress established a forum, the Federal Reserve, to determine monetary policy in an atmosphere that is remarkably free from day-to-day political pressures. So, within this context of independence, the Federal Reserve strives to help the economy grow by avoiding the problems of too much, too little.
Hi, Priscilla.
Hi, Matt.
How are you?
I'm good. Real good. How's the car running?
Oh, great.
Yeah?
Great,
Oh,
yeah.
good. No problems.
No, matter of fact, no problems whatsoever.
Oh, great. Well, that's good to hear. Oh, thanks.
You're welcome. Watch yourself there. I can. I didn't have any problems coming over here. Must be the clutch or something. I don't know.
Scenes of Independence Hall and old-time banks, courtesy of Knott's Berry Farm Amusement Park, Anaheim, California.
To obtain a copy of the Teacher's Guide for Too Much, Too Little, contact Public Information Department, Federal Reserve Bank of New York, New York, New York, 10045.